So what do you get when the US releases a jobs report that's 48 days late, but still manages to shake markets overnight? A reminder that in finance, timing isn't everything, the impact is. So before you place your next trade, watch this. Good morning. I'm Francois, your market analyst here at ATFX Africa, and welcome to your daily market brief, where each morning I unpack the biggest movers across currencies, commodities, and indices, blending fundamentals, technicals, and adding just the right amount of common sense. Because let's face it, markets don't always make sense. Let's start things off today with GBP USD, where the pound is dealing with two big forces all at once. Number one, a sturdier US dollar. The US dollar index is holding above 100, set for nearly a 1% gain on the week. Markets are increasing expectations that the Fed is going to avoid cutting rates in December, especially after the delayed jobs report. NFP showed faster employment growth in September as well, though the unemployment rate rose to 4.4%, a 4-year high. On top of that, Fed Governor Michael Barr reinforced the cautious tone, warning that inflation is still above target. The Fed needs to be careful about further rate cuts. Net results of all of this? Well, the dollar remains broadly supported and it's finishing the week stronger against most majors. In the second part that GBP USD is struggling with is a softer UK inflation backdrop and budget uncertainty. The British pound fell towards $1.30, near a 7-month low after data showed a clear easing in UK inflation. Headline CPI dropped to 3.6% in October, helped by lower electricity and heating costs after the off-gem price cap changes, plus cheaper hotel prices. Service inflation eased more than expected to 4.5%, and core inflation moderated to 3.4%. This gave the Bank of England and the UK government some breathing room and handed Finance Minister Rachel Reeves extra momentum heading into the pivotal November 26 budget meeting. At the same time, the pound is trading with a risk premium attached. A U-turn on income tax hikes has rattled bond investors. The December Bank of England decision is, well, finely balanced, and a restrictive budget plus upcoming data could tip the scale towards a rate cut. Looking at the charts, despite all that pressure, GBP USD is currently around 1.309, up 0.1% on the day, though still down 2.02% over the past month and up 4.45% over the past 12 months. So the bigger picture for the cable right now, well, US side, we are looking at the Fed likely to hold in December, which is supporting the dollar. On the UK side, inflation is easing. Budget risk and policy uncertainty is also weighing on sterling. So price is hovering near that 1.3 support zone, where buyers and sellers are negotiating whether this is a temporary dip or the start of something deeper. The recent slide over the past month suggests downside pressure remains, but the intraday bounce towards the resistance level at 1.315 hints that the markets are not yet ready to abandon sterling completely. With the November 26 budget approaching and the Fed's December meeting in view, cable remains a classic two-sided story. Moving on to gold, where the metal is caught between a stronger dollar and lingering macro worries. Gold is trading around $4,055 per ounce, heading for a, well, modest weekly decline. The delayed September NFP report showed 119,000 new jobs, well above the 50,000 forecast. Unemployment came in at 4.4%, the highest since October 2021, and the average hourly earnings at 3.8% year on year, slightly above the 3.7% expectation. This combination, well, it confirms the Fed's view of a labor market that is cooling, but still steady. which is keeping wage inflation just a bit hotter than the market might like and helps push back against aggressive rate cut expectations. Rate cut probabilities for December have now dropped further down towards that mid-30s range, and that has supported the US dollar quite a lot, now near its highest level since late May, and pressured gold, which is struggling when real yields and the dollar pushes higher. At the same time, concerns about weaker US economic momentum after the longest government shutdown, and while a generally weaker equity tone and geopolitical risk, including ongoing negotiations around US-backed Ukraine peace plan, and well, all offer gold some safe haven support underneath. So gold is stuck, in other words, in a bit of a tug of war. Less dovish Fed expectations equals headwind. Risk and geopolitical concern equals tailwind. So when we look at the charts, gold remains in a range with some important levels in play. Price is holding above a nearly 1 month old ascending trend line around $4,020. That trend line coincides with the 200 period exponential moving average, creating a confluence support zone. If that 4,020 area breaks decisively, gold could slip back below the 4,000 psychological level and then target the support near 3,945. And beyond that, the late October swing low around 3,886. On the upside, bulls need a sustained break above 4,135 before getting excited again. Above there, the next resistance zone sits at 4,195 and then 4,265, with a further extension potential eyeing the 4,400 round number. Right now, gold is on the defensive, but not collapsing. The chart is signaling hesitation rather than a one-way market. Finally, let's head to UK equities. The FTSE 100 is currently on a 6-day losing streak after dropping 1.4% on Thursday during the US session. Earlier during the UK session, it did rise 0.4%, helped by oil-linked names and defensives like Rolls-Royce, which was up 1.5%, BAE Systems up 2.3%, BP rose 0.9%, and Shell rose 1.1%. Halma was the standout, which surged over 9% after raising guidance on strong first half trading in its environmental and analysis unit and is now expecting mid-teens organic growth and adjusted margin near 22%. On the flip side, utilities weighed on the index. National Grid, Fresh Nilo, and Vodafone all traded lower. JD Sports slipped nearly 3% after guiding full-year profits towards the lower end of expectations as like-for-like sales fell in quarter three. Sentiment across equities was also supported by Nvidia, which delivered a stronger than expected revenue outlook, helped ease some concerns about the AI cycle, and floated the idea that its coming $500 billion sales surge could even beat forecast. So while global markets are nervous about valuations and central banks, the FTSE did benefit from sector rotation into defense, energy, and quality defensives, and ongoing interest in names benefiting from the evolving AI and tech landscape. Looking at the charts, FTSE is sitting around 9,450 points, up 0.5% over the past month and 15.6% higher than a year ago. The recent 6-day losing streak looks more like a correction within an uptrend than a complete change in direction, especially given the strong bounce in key constituents and the broader based sector support from defensive and oil stocks. For now, the index seems comfortable consolidating below the highs, while investors digest global rate expectations, AI-driven tech volatility, and the UK's own budget and policy uncertainty. So to wrap up today, sterling is caught in a tug of war between a stronger dollar and softer UK inflation, with a budget risk premium smoldering in the background. Gold is pinned between a less dovish Fed and lingering global uncertainty, holding key support but struggling to break higher. And the FTSE 100 is quietly reminding everyone that underneath the headlines, defense sectors and quality names are still very much in play. The big question going into next week is, well, will the incoming UK budget headlines and the next wave of US data reinforce the current trend or flip the script completely on sterling, gold, and equities? We'll break that down next week in your daily market brief. And with that, we wrap up today. Brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Head over to ATFX by clicking on the link in the description and we'll go and experience the difference for yourself. It is until next time, stay sharp, stay focused, and trade smart.